All right, so the term dove is like a bird. It's just like flying around. If you think about the stock market, there's always these animal type terms. Well, here's another animal for you. The dove represents a financial policymaker that believes interest rates should be kept low and that inflation isn't bad. So basically the dove supports the idea that low interest rates encourage economic growth. And because it encourages economic growth, it encourages borrowing, right? So when interest rates are low, companies are willing to borrow to expand their office building, maybe fund a new project. You can also see that people may be willing to buy houses or buy more house than they normally would buy if the interest rate wasn't as low, because what that translates to is a lower monthly payment. So if the payment is lower because of the interest rate, you can kind of afford a more expensive house because your payments might be the same if interest rates are low. And so those are some of the things that a dovish economic policy having a low rate will affect. Now, the doves believe that this doesn't really have that much of a negative effect, but you can kind of see coming out of the pandemic how this could have a negative effect on the economy. Well, let's think about it. If interest rates are low and everyone is able to basically borrow money for pennies on the dollar, which means I can borrow money and buy something that I normally wouldn't be able to afford, but the interest that I'm paying on it is maybe 3 cents on a dollar. It pulls forward supply, meaning people can buy things that they normally wouldn't buy right now, which could disrupt the supply chain, thus causing inflation and actually making things become more expensive because more people are able to afford it, or they're able to afford it right now all at the same time. And then when that happens, that causes supply chain disruption. So there could be some negative benefits to a dovish policy or a low interest rate environment for too long of a time. Then you see the same thing with houses. Again, if there was a $200,000 house and the interest rates was 6%, let's just say your payment would be, let's just say for example's sake, $2,000. Well, now when interest rates are low, so if interest rates are 6%, $200,000 house, your payments are $2,000, you can afford potentially a $300,000 house if interest rates are 3%, because your payment would still be $2,000, but that interest rate makes the difference in whether you're going to pay more than $2,000 or less than $2,000, or reverse, if you can afford a $200,000 house or now a $300,000 house. And that's where you saw people coming in that normally would be able to afford a $200,000 house, willing to pay $225,000, $250,000, $300,000, $100,000 over asking price, because it doesn't matter technically to them because their monthly payments are going to be the same. And sometimes that's all that consumers care about is, what is my monthly payment going to be? So you can see how that can cause some problems in the economy. One other thing that a dovish policy could do for disrupting the economy is sometimes people can do things that they wouldn't normally do when they can borrow money real cheaply. So sometimes people may borrow money and say, I'm just going to stop working for this year and I'll figure out how to pay that money back later, because the interest rate on it and the payments are going to be super low. And so it could actually have a negative effect where we're looking for expansion. We're looking for companies to borrow money, build businesses, expand their offices, do different things like that. Also, it encourages entrepreneurs to probably start a business that they wouldn't normally start it because they're borrowing money. But then on the flip side, as they expand, start these businesses, the people who figured they'll borrow money and just live off of it now puts us in a situation where if we expand, nobody actually wants to come to work. So there needs to be a balance between dovish and hawkish financial policy, but I hope that explains a little bit better what a dovish or low interest rate policymaker is all about. So when you hear someone say the Fed was dovish today, they were more favorable of lower interest rates. And if you don't understand what hawkish is, be sure to check out the next video, because we're going to dive into what does it mean for the Fed or anyone to be hawkish. I'll see you in the next video.